All right, let's dive into something that, let's be honest, can seem pretty intimidating: financial options. But what if I told you they're way simpler than you might think? If you stick with me for the next few minutes, you'll get exactly what they are and, more importantly, why they're such a big deal.
So, let me start by asking you this. Imagine a stock you're watching goes up by 10%. Pretty good, right? You'd be happy with that? But what if you could take that exact same 10% move and turn it into 100% profit for yourself? I know, it sounds almost like a magic trick, but it's the absolute core of why options are so fascinating.
In fact, why even stop at 100%? How about a 175% return? And look, that is not some made-up number. It comes from a real-world example, and we are going to break down exactly how that happened, step by step.
So, you're asking, what is the secret sauce here? How do you get these huge returns? Well, it all boils down to one incredibly powerful idea: leverage. The best way to think about it is using a small lever to move a huge object. You're using a tiny bit of money to control a much, much larger asset. Here's exactly how that plays out. Let's say you want to buy 100 shares of a stock that's trading at $49. That's going to cost you $4,900. If that stock goes up 10%, you make a 10% profit. Simple enough. But what if you could control those exact same 100 shares for just $200 by using an option? All of a sudden, that same stock move gives you a massively bigger profit on your tiny initial investment.
So what in the world is an option, really? It's not a tiny piece of a company like a stock is. It's actually a lot simpler than that. At its very core, an option is just a contract. That's it. An agreement with really specific terms and, crucially, a deadline. And this contract gives the person who buys it the right, but, and this is the key part, not the obligation to buy or sell a stock at a price that's already been agreed upon before a certain date. Let's say that again. The right, but not the obligation. Now let's break down the two most important parts of this deal.
First up, we have what's called the strike price. This is the price that's locked into the contract. It's the reference point. It doesn't matter if the stock soars to the moon or drops like a rock on the open market. The strike price in your contract stays put. It's the anchor for the whole trade.
And the second key ingredient is that time frame. See, unlike a stock that you can buy and hold pretty much forever, an option has a shelf life. It has an expiration date. And after that date passes, poof, the contract is worthless. This ticking clock is a huge part of the game, and it's a trade-off we're definitely going to come back to.
Okay, so you've got a contract, you've got a fixed price, and you've got a deadline. The next question is pretty straightforward. Which way do you think the stock is going to go? And that leads us to the two basic flavors of options, one for when you think the stock's going up and one for when you think it's heading down.
It really just breaks down like this. If you are bullish, you think the stock price is going to rise. You buy what's called a call option. That gives you the right to buy the stock at that set price. On the flip side, if you're bearish, you think the price is going to fall. You buy a put option. That gives you the right to sell it. So think calls for up and puts for down. It really is that simple.
All right, let's tie this all back to that 175% profit I mentioned. Here is exactly how to trade like that works. A stock is at $49. You think it's going up, so you buy a call option for $200. This contract gives you the right to buy the stock at $50. Well, a month goes by, and you were right. The stock jumps up to $54. Your little $200 contract is now worth $550. And why? Because it gives the owner the right to buy a $54 stock for only $50. That right all by itself has a ton of value. So you sell the contract, and you've made a $350 profit on your $200 investment.
I mean, just look at that difference. The stock itself, it only moved up about 10%. The decent gain for sure, but your investment, that $200 you put on the line, it shot up by 175%. That is the power of leverage. It's like using a tiny key to turn a very, very big lock.
But, and believe me, this is a really big but, that incredible leverage, it doesn't come for free. There's always a trade-off. With options, what you're really doing is trading the long-term safety of just owning a stock for the short-term supercharged power of a contract that has a ticking clock.
So here are those core differences laid out. With a stock, your profit is pretty much one-to-one with the price movement. With an option, it's amplified. A stock can be held forever, but an option is always on a timer. And this is so important. When you buy an option, the absolute most you can ever lose is the money you paid for it. That's it. Your risk is totally capped right from the start.
You've heard this old saying a million times, right? Well, it has never been more true than in the world of options. That expiration date we talked about? It's not just some minor detail. It's a fundamental force that is constantly pulling on the value of your contract, every single day.
And here's why that matters so much. If you own an option, every single day that goes by where the stock doesn't make the move you're hoping for, well, a little piece of your option's value just vanishes into thin air. It's a concept called time decay. For an option buyer, the clock is always ticking against you, and that is the price you pay for all that amazing leverage.
Okay, we've covered a lot of ground pretty fast, so let's slow down for a second and just boil it all down to the absolute key things you need to walk away with.
If you remember anything, remember this. An option is just a contract with a deadline. You use call options when you think a stock is going up, and you use put options when you think it's going down. Their real magic comes from leverage, which can blow up your potential profits. But the price you pay for that leverage is time. That ticking clock, that expiration date, is always the option buyer's biggest enemy.
And that really leaves us with one last big question to think about. If time is the cost of leverage, then the most important decision you'll ever make is how much time you're willing to buy yourself. See, choosing the right option isn't just about being right about which way a stock is headed, it's about being right within a specific window of time. So, how much time is enough? That's the billion-dollar question every single options trader has to answer for themselves.